If you want to see a remarkable improvement in your trading, you need to change. If you want to create a future in trading that is different from the past, you have to change. What do I mean that you have to change? You have to change the way you look at the market. I want you to delete everything that you have learned from YouTube videos and listen to me in this video carefully. Trading can be difficult and very frustrating if you do not understand what is going on the chart. The market is a web of confusion to the unlearned. But when you have the right knowledge, then you will realize that trading could be simpler than you expected. There are three major things you need to change your orientation towards. Number one is the structures of the market. Irrespective of the strategy you are using, if you don't understand whether the market is buying at the time you open your chart or selling, you will always be on the wrong side of the market. Oh, you may say you have already understood that. You know how to identify the structures of the market. But look, listen to me. The structures I'm talking about are only two. One is the external structures, and two, the internal structures. You use your external structures to identify the bias of the market, and you use your internal structures to take trades in continuation of the bias that your external structures have set. You really need to pay attention, because a lot of traders just jump on the charts and start taking all kinds of trades in the market, and you have about 95 to 97% of traders losing money every single day in the market. So in this video, I'm going to walk you through step by step, simple and straightforward. Okay? When you're talking about your external structures, you are talking about your major swing highs and lows in the market. Simple. And if you have been following me for some time, you realize that I've always been talking about that for you to identify a valid swing high, price needs to take out inducement. If it doesn't, you don't have a swing high in place. If it is in a bearish structure, price has to take out inducement for your swing low to be confirmed. If it doesn't, it means there is no trend in place. So you need to sit on your hands. Now, let me take you to these diagrams and show you what I mean. Take a look at this first diagram, which is a bullish structure. You have liquidity swept there. That liquidity is known as inducement. And after that liquidity has swept, this will confirm your swing high. This is what is known as a swing high. Okay? Now, your swing low, in the case of a bullish structure, will not be confirmed until price travels back up to take out the swing high and has to close above it. And then, once that happens, that means this your swing low is confirmed. It's as simple as that, guys. So what you are interested in is this swing high and this swing low. Irrespective of any strategy you are using in the market. This is what you are watching: swing high and the swing low. That's all. I'm still talking about the structures of the market. I told you 3 things you have to change your orientation towards. I'm still talking about the number 1 thing, which is structure. Because if you don't understand this, irrespective of the strategy you use, like I said, irrespective of the indicators you are using, whatever that you are using in the market, all will come to naught. Because the smart money follows the flow of the market. Moving on, price now created this high, but this high did not take out any liquidity. Without liquidity in the market, don't attempt to enter, because you will become the liquidity. It's as simple as that. Now, price pushed up and printed this high. And when it printed that high, where is your inducement? Your inducement will then move to this point. This becomes your inducement in the market for this high. Let me tell you something. You see this leg that is coming down? Look at the way it's coming down. Lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and all of that. Price is clearly bearish here. Now, some traders will pick this bearish move here on the 5 minutes time frame, and then they will see a massive downtrend, and they will think that on the 5M price is actually bearish, whereas on the 1H price is bullish. This is just a retracement. I just hope you understand this. This may sound very simple, but this is what has been dribbling traders in the market. So inducement is taken out. You are less concerned with all of this. Once inducement is taken out, your high can now be here, confirmed. But your low will not be confirmed just yet, because price is making lower low, lower high, lower low, lower high, lower low. Why is it making this lower low, lower high, lower low, lower high? It's because it's retracing. Simple. All that you are watching is your high and this your low. The low is still okay here. As long as price does not come down like this, as long as price does not come down like this to take out this low and has to close above it, below it, as long as that does not happen, this uptrend is still valid, is still in place. Okay? And now you are waiting until price travels back up to take out this major structure high, this swing high. You don't have a swing low just yet until price takes out this swing high and has to close above it. Now, as you can see, it has closed above this high. So you can now identify your swing low here. It must be the lowest low. So that's your swing low. You do not pay attention when you are marking your structures or you want to identify the bias of the market. Don't pay attention to all these small, higher, lower, low, lower, high, lower, low, lower, high, low. Don't pay attention to it. Or all of this higher, low, higher. Don't pay attention to it. It's the swing. These swings are known as the external structures. These external structures tell you the bias of the market, not the internal structures. You use internal structures to take trades in line with the external structure trend. So that is how to do it. The same thing in a bearish structure. Look at it. Price went higher and came back down. Will you call this major structure low? No, because I know a lot of traders will mark this as major structure low. You can mark it if you are not using the true smart money concept to trade. But if it is the true smart money concept, this is a no-no. This is wrong. This is internal structure, and we are not focusing on internal structures just yet. We are looking at the external structures of the market. And now, price printed this low. Is this low valid? Or let's start with this low. Is it valid? Of course it's not, because it didn't take out any liquidity. And now you have this low. Is this low valid? Yes. For it to valid, it has to take liquidity in the form of inducement. And right here is that liquidity that is taken in the form of inducement. Once that liquidity is taken, this your low is now confirmed. And your lower high, in the case of this bearish structure, cannot be confirmed just yet until price comes down to take out this low and close below it. And as you can see, that happened there. So you can actually now mark your lower high. This becomes your lower high. Simple. You are less concerned with lower low, lower high, lower low, lower high. You are less concerned with all of this. What you are looking out for is this high and this low. In a bearish structure, you are expecting the lows to be taken out, but the high must be protected. This is what is known as a strong high. It has to be protected. In a bearish structure, strong highs are protected. In a bullish structure, strong lows are protected. What makes a protected low to be strong in a bullish structure is when it has taken liquidity. What makes your high in a bearish structure to be strong is when it has taken liquidity. Okay? So now, after that, price printed this low. When you see this low and price started moving higher, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, and all of that, if you go to the lower time frame, you will see this leg as a massive uptrend. If you just get to your 5M, for example, or your 1M, whatever lower time frame, you will find that this leg is a massive uptrend. Now, if you are the type of trader that does not check your higher time frame, you would think that the market is bullish and you want to enter your trade going long, whereas the market is simply bearish. This is just a retracement, because if you don't understand what goes on, look, when price took out, you will say this is inducement taken out, that this is higher high, higher low, and then that inducement is taken out here. And once you can identify that inducement is taken out there, you will want to take your trade. Maybe you will find an OB here. You want to take your trade to go long. And before you know it, price will come back down to take you out. Why? Because you didn't understand your higher time frame swings. Very important for you to understand that. So now, you are not interested in all this higher high, higher low, higher high. All that you are interested in is that this high, this lower high, is a protected high, it's a strong high. Price must not take it out and close above it. Because if it happens, that means that this downtrend is over. I hope you understand what I'm trying to say. That's the first area that you need a change of mindset. The second way that you need to change is liquidity. The market moves primarily because of liquidity. I have explained a bit of liquidity here called inducement. Now, I want you to know these internal structure highs and lows are inducement levels. The reason why you are seeing price taking out, if it is an uptrend like this, the reason why you see price go like this, taking out this high, is because this high is liquidity. Liquidity rests above this high. That's why you see price pushing up to take it out. The reason why you see price coming down to take out this low and you call it inducement is because liquidity rests below this low. Okay? I want you to understand that very, very well. The same thing in a downtrend. The reason why you see price coming down to take out this low here is because liquidity rests below this low. The reason why you see price going up to take out this high is because liquidity rests above this high. And that's what we call inducement. I hope you understand what we're trying to say here. Please try and understand. So liquidity is key in the market. Irrespective of the strategy you are using, if you don't incorporate the concept of liquidity into your trading, you will always be on the wrong side of the market. Because the reason why price moves the way it moves on your chart is simply because of liquidity. I'm telling you the simplistic way to approach the market and become consistently profitable. Okay? I don't want to give you complex, because some of you think that it has to be complex strategy. You have to have some complex indicators on your chart and all of that. No. Simple, straightforward system. System that is replicable over time. System that if anyone picks your setup and looks at it, will be able to know the roadmap to that trade you have taken. Okay? So that's number 2, liquidity. And then number 3 is your area of interest. For example, this was your high and this was your low. I mean, this was your high and this was your low. And price rotated back down. After it rotated back down, there are two areas of interest within your trading range. By the way, this is your range low and this is your range high, for example. And so price rotated back down. The first area of interest is this area of interest here, this one. This is your first area of interest. Or if you like, this is your first area of interest, which is called decisional. So price can tap into that decisional area of interest and decide to go long. As you can see, in this case, it went long. But sometimes the decisional area of interest is low probability because it's 50-50. So you have the extreme area of interest somewhere here. That one, we call it that it is high probability. Why is it? It is because if price breaks and closes below this low, it therefore means that this uptrend is over. That's why this is known as high probability zone. The same thing here. I don't need to go over and over it again. For example, let me show that to you. This is your decisional area of interest, for example. No, let's not use that one. Let me use the swing, the right swing. Where is the right swing? This is swing high and this is swing low. Why? Because it has taken out inducement here. Look, your inducement. Where is your inducement here? This becomes your inducement. So it has taken it out, as you can see. So now, once it takes it out, because you need to wait for inducement to be taken, you have your area of interest somewhere here. Okay? Simple. If you don't find 2 areas of interest, you will find 1. But it has to be after inducement has been taken. I hope you understand. These are the 3 things you need to become consistently profitable in the market. You don't need any other thing. If you can master these 3 concepts I've told you: 1, structure; 2, liquidity; 3, your correct area of interest. That's all. That's all. Somebody was asking, what system am I using to take trades? I am making this video to answer that question. This is what I do to take my trades. I follow only 3 things in the market. 3: structure, which is your bias; liquidity; and then my area of interest. That's all. You don't need to stress yourself. Let me take you to the live chart and show you what I mean. Okay. This is XAU USD 1H time frame. If you want to follow me on your chart there, let me tell you the date is around 22nd of July 2025. So you can follow me there. Now, as you can see clearly, we are pretty much bullish. Price is breaking the highs and maintaining the lows. These are the three nuggets I want you to concentrate on if you want to become consistently profitable in the market, like I told you before. The first one is structure. You must identify the structure. You don't need any other thing other than these three concepts. Okay? Now, structure. Look at this. Let me show you what goes on here. Maybe from this low, price pushed up and then came back down to print this low and then went back higher. Okay? So where is your inducement? When price is coming back down, this is going to be your inducement here. Simple. Once it takes out that inducement, then you have a swing high in place. And therefore, let's mark it out properly. So this is your inducement in the market to confirm this high. Once this inducement is taken out, this high will be confirmed. So we continue. So as you can see, inducement has been taken out, and therefore we can now confirm our high as a major swing high in the market. So we have a swing high in place, but we don't have a swing low. We need to look for that swing low, and you know how to identify your swing low. So let's get backward and find out our swing low. Now take a look at this. Let me show you what is happening here so you can understand. Look at this. Is this high actually a swing high? Let's identify that one first of all. If it's going to be a swing high, it has to take out inducement. And so where is the inducement? Inducement is right here. And as you can see, it took it out, meaning that this high is a valid high in the market. So we can mark out that high as a valid high. Now, your higher low in the case of a bullish structure cannot be confirmed just yet until price takes out this very high and close above it. And as you can see, that happened here, the closure above. So meaning that this is your swing low. So we can actually mark this one out as our swing low. So we have a swing high, swing low now in place. That's it. That's your swing high and that's your swing low. Now remember that I talk about external structures. So external structure is this external structure high and external structure low. This is what I mean by external structure. Every other structure in between this high and low is simply minor structures. They are internal structures. So our trading range is here. Let me zoom out for you to see our trading range. This is our trading range. Range high, range low. So we are done with structure and then liquidity. You know, this is our structure and this is the liquidity. The inducement is the liquidity. I hope you understand. So the next thing now is POI. So if we look at it, number one, structure, check. Number two, liquidity, check. Number three is what we want to look at right now. So how do we determine our areas of interest? Well, there are only two areas of interest that work within your trading range. Your decisional area of interest, which is after inducement. That's your decisional area of interest. And here is your decisional area of interest. Just like so. That's your area of interest. That's number one. And then the extreme is right here. Let's look at the extreme area of interest. That's your extreme. Every other thing here is mitigated. So this becomes your extreme because it's unmitigated. All right. So we have two areas of interest, decisional and extreme. So let's continue to advance price. So all the three concepts are present here now. Simple. So we continue to advance price. So as you can see, we are tapped into that decisional area of interest. And one more thing, remember that the decisional area of interest is 50-50, it's low probability. Okay, but your extreme area of interest is high probability, because if it takes it out and then takes out this low, that means that we have been converted from this bullish structure to bearish structure. Simple. Please follow me. Just delete every other thing you have in your mind. Now let's continue. So that decisional area of interest has failed, so we can take it out so it doesn't confuse us, and then we are looking for price to go to the extreme. Okay, so look at the extreme. Extreme is also look like it's not going to. Let's see whether it will hold price. So it's not holding price, it has taken it out. So now that the two areas of interest have been taken out, what is the option left? What is the remaining option now that is left? The remaining option is that if it takes out this major swing low here with a candle wick, we can go higher. Okay, so we continue to advance price and let's see what happens. Now it has taken out this major structure low here. All right, it has taken out the major structure low, so now it has closed below it. What do you call that? That is change of character. So we have been converted from this bullish structure to bearish structure. Let me show that to you quickly. We have been converted from this bullish structure. We were bullish before, now we have been converted to bearish. Now remember, before we converted, we followed all the three concepts. All right, we followed all the three concepts. So we are now bearish, so we can take out this zone. So this is our high, our swing high still valid, our swing high still valid, and our swing low is yet to be identified until price takes out inducement. And so where is the inducement here to confirm our swing low? Well, the inducement we have is right here. That's our inducement, okay, our liquidity. So if price takes it out, then this low will be confirmed as our swing low. Right now, we don't have a trading range in place just yet. Let's continue. Let me zoom in. I want you to see clearly what we are doing. So as you can see, it didn't take out this inducement here. Instead, it created a new low. Now, when it created this new low, it pulled back and dropped and took out this low here. So our liquidity can be transferred, which is inducement, to this zone here. Simple. So we continue. Now it has taken out that liquidity. Once it takes out that liquidity, we can now mark our swing low. So this becomes our swing low. Simple. So where is our high? Our swing high is here, and our swing low is right here. So now we have a trading range. The whole of this zone is our trading range. And therefore, remember our rules, our three concept structure. We have swing high, we have swing low. So structure confirmed. Now, the next one, liquidity. Look at our liquidity here. Taken out, confirmed. Now, the third thing is POI. Now, where are your areas of interest? Only two work within your trading range. So if we start from the extreme here, let's look at the extreme order flow. Look at this. Concentrate only on the order flows first of all. This is your extreme. After the extreme, we have the one after this inducement. And where is it? The one after inducement is not this one, because this one is already mitigated by that inducement. So we cannot use that one. Now the next one already has been mitigated. Look at this. This one is already mitigated by this pullback. So we cannot use that one. So the next one, let's look at the next one. Next one has also been mitigated. Look at this, by this pullback. So we can't use that. Let's look at another one. The next one is this one. which is unmitigated. So these are the two areas of interest. Any other one is a smart money trap. So these are the two areas of interest we look to take our trades from if price comes into them. Now remember, the decisional area of interest is low probability, the extreme is high probability. So we can continue to advance price and see what is going to happen. Okay, so price has come into this, I think it appears it has come into that zone, but let's see whether it is going to hold price. As you can see, it didn't hold price. It took out that zone and closed above it. So this zone couldn't hold price. So the next zone we are looking at is just this one. If it takes out this one and takes out this high, that will be a change of character. So let's continue to advance price. Remember, our zone is still here. So let's get to the 4H and make it faster. I don't want this to be too long. Let's see whether our zone, it will get to our zone. It's not getting to our zone. Let's get back to that 1H so we don't miss track of what we are doing. Okay, now, but I want you to follow price as price is going higher. Look, you can track price as it's going higher. All right, after this inducement, look at what happened here. Price pulled back and went higher. So if it went higher, this is going to be your inducement. This is going to be your inducement, but inducement was not taken out, okay, before creating a new high. And for that new high, it needs inducement. These are internal structures. Now I'm showing you all of these are internal structures. Okay, our external structures are this and the one below here. These ones are internal structures. This is where you can capitalize to take your trades in the market if it gives you any opportunity. Now, for example, there is no inducement taken out here, so we cannot enter any trade going higher. But as you can see, it's making higher high, higher low in that progression. Okay, so now it created a new high here. All right, for this new high to be confirmed, it needs inducement, and so this inducement can be taken to this point. Now remember, these are internal structures, okay, and now it didn't come to take it out, it created a new one. So for this new high, it needs inducement, and so this is inducement. This is inducement here, and as you can see, that inducement was taken out. Once inducement is taken out, let's begin to look at our areas of interest. These are internal structures. I told you your external structure is to help you identify the bias of the market, and then internal structures will help you to take trades in the market. So now it has taken inducement there. So our area of interest can be this one. This one is already mitigated by this pullback, so we cannot use that. Okay, now the next one is this one here. We are starting from down here. The next one is this one. Okay, so that's the only one available that is unmitigated. Every other one is mitigated. So here we want to wait for price to come into this one to tap into it, and then once it taps into this, remember we are still going here. As price is coming down, if it doesn't go to tap on this and comes to tap on into this, we want to take price higher. So we'll continue. I hope you understand this thing I'm doing. Where is this our three concept? Let me bring it closer to us here. Let me bring our three concept closer. This is our three concept that we are still following. Please remember that. This is our three concepts that we are still following. Okay, so now we have structure. This is internal structure. Let's mark it out. This is internal structure high. This is internal structure high. Remember, that is internal structure. It's not major structure. This is your major structure high here. This one here. Let me bring it back for you to see. Look at our swing here. This is our external structure. This is our external structure. That's our external structure. Okay? So this is internal structure. I want you to understand that very, very well. So we can continue. This is where we want price to come into, and then we can take our trade going higher. Look at it. This three concept is what we are following. Simple. Let's get to the 4H and make it faster. Okay, it appears on the 4H price has come into this. Now, let's get back to the 1H now. So price has come into this zone. So once price comes into your zone, what do you want to do? You want to take, let me bring back our, where is our 3? Yes, this is it. We are still here. We are still there. So now price has come into this zone. We want to take, now it has tapped into it. We need chalk before we do anything in the market. We need chalk. And so where is the chalk here? Look, price printed this low and went back higher before coming back down. So this will be our change of character here. If price takes it out, that will be our change of character. But let's see what happens. Okay, price has taken out that our change of character and has closed above it. All right, so now if it has taken out that change of character, that means that our internal structure here is it our low. Okay, and now after this inducement, this chalk has been taken, we need to wait for inducement. So let's continue to advance price. Price pulled back here and went back higher. So if price comes back down to take out this low, that will become our inducement in the market. So we can take trade from there. Price printed a new high. So our inducement can be transferred from here to this point. Okay? And so if inducement is transferred from there to that point, that means that we have our area of interest here. That's number one. So let's continue. And so price has tapped into that area of interest. So remember, this is decisional. This is the low here. So if we want to look at it, this is another area of interest we can look at. This one. But if we mark this, it's not mitigated, it's unmitigated. Okay, because this one, this is the low. This will be high probability than this one. But let's look at what happens. Let's continue to advance price. So, boom. Can you see what is going on here? So the decisional area of interest held price and pushed price higher. So you would have taken your trade from here. Price did not come to the extreme. It went to the decisional and went higher. Can you see the massive candle? And therefore, this becomes your internal structure high. So you could have taken trade from here to go higher. Take trade from there. And this would have been your trade there. All right. So you would have given it about 3 point something hour. and then you would have trailed your stops from there. Okay, so this is the high, internal structure high. Remember that one, internal structure high. So let's continue to see what happens in the market. Okay, so price has taken out this high again. This is internal structure high. It has taken it out, and then your inducement is right here. If price takes out this inducement, this one, if it takes out this inducement, then where is your area of interest likely to be? Your area of interest will likely to be here. Will likely to be here. Let's continue to advance price. And now we have a new structure in place. Is there any inducement here? No. This inducement is still valid. Why is it? It is because this high and low of this candle protected. All right. Now, this one again, high and low protected. So there is no inducement. This inducement is still okay where it is. We continue. Okay. So this is the current market price right now. Today being Wednesday, I think Wednesday the 27th of August. So, but we are expecting that price will take out this inducement. If it takes out this inducement, to come into this zone for us to be able to buy. All right, these are internal structures. Where are we buying to? If we buy from here, if price should come back into this zone, into this very zone, where are we going to target? Remember, where is your high? Your external structure is right here. This is your external structure high. Okay, this is where we want price to come into. This zone is where we want price to come into. If it comes into that one and gives us any reaction, then we can go short from there. All right, because we have been converted to bearish structure. Okay, so this is the way for you to use both your external structures and the internal structures to take trades. Please watch this video again and again, and then you will understand exactly how to really navigate the market. Follow these 3 steps: structures, liquidity, and POI. Simple and straightforward. Follow these 3 steps, and then you will be good to go in the market. All right, guys, if you are new to our channel, please consider giving us your subscription and turn on the notification so that anytime we publish a new video, you'll be notified about it. And if you want to really upgrade your trading skill, you can join our VIP community. The doors are open for you. I'm going to leave the link in the description. And if you haven't joined our free Telegram channel, please do so just immediately, because right there we post high probability trade setups which can help you to make money in the market before joining the VIP community if you don't have the money to join right now. All right, guys, I see you in our next episode. Thanks for watching.